The below 1% number, I think, is a correct number. But to put it in context, a lot of the investments out there could not be in gold because they'll be, for example, an S&P 500 fund. It cannot be in gold. It'll be a fund dedicated to small caps. Can't be in gold because gold isn't an equity. So there's a lot of funds which just can't be in gold at all. So when I say below 1%, it's an accurate figure from what I understand, but it obviously it does encompass all kinds of investment vehicles which couldn't own gold under any circumstance, not allowed to, because it's not part of their mandate. So probably the real figure, which is actually invested where it's allowed to be invested in gold, is probably more like 2.5%. So I'd say for those mandates which can invest in gold, if they can get to 5%, we've got a large rise in the price coming. Well, first of all, there was something which made me quite laugh this morning, and I won't name the bank, but it's a very major US bank, came out and said gold could reach $4,000 an ounce. And I looked at the price, it was $3,977. I thought, why do they wait until it's $23 away from the $4,000 mark to tell us it's going to reach $4,000? I mean, that's kind of an easy one. But I suppose they just want to say, we predicted it. Of course, you and I and many of your viewers have been saying that gold could go up to 4,000 and beyond. And we've been saying it for years. I think it's gone faster than many people expected, and the whole world, and I get many messages about from people saying this, when's the pullback coming? I'm not in, I want to get in, but is there going to be a pullback, and at what price should I put my limit? And I think the reality here is a lot of people missed the boat, or feel they missed the boat, and so every time there's a pullback, they say, oh, it's happening at last, I'll get a lower price. And then that pullback starts to bounce, and they say, oh, am I missing the boat? And they'd rush in, and then it gets pushed to another all-time high. So I think the problem we've got, it's not really a problem, it's just a feature, that gold wants to go higher. There's a lot of people who don't have enough of it. They'd like to buy at lower prices. They're waiting for that lower price. And every time we get a couple of percent off, if you're lucky, you get your order in when it's a couple of percent off. But the reason it's going higher at the moment, I think, is just a general uneasiness about holding large cash balances. And that's not just in dollars, it's euros, pounds, yens, whatever you like. Maybe not Swiss francs so much. But those who've got large cash balances feel that they're not sure what tomorrow holds. There's a feeling we moved into a more unstable world where the pronouncement from some president somewhere can suddenly change the landscape for your currency. And, and people are saying, well, we've got in Europe, we've got political crisis in France. UK, it's sort of edging on the edge of a political crisis. USA, there's a huge political crisis. People say, well, what's coming tomorrow? And the feeling is they've got to do something with their money, which isn't cash, because they just don't know what's going to happen down the line.
Throughout bull runs, many investors fall into a psychological trap, waiting for a dip that never fully arrives. They resist buying until cheap and then chase as the price rebounds. For gold now, that pattern is especially strong. Those who feel late are often compelled to enter at elevated levels, fueling further upward pressure. Compounding this is a widespread discomfort with holding large fiat balances, whether in US dollars, euros, yen, or pounds. In a restless world of policy risk, many feel compelled to move capital into a more stable asset, gold.
I think we've got a little bit frothy, but that means we're kind of ripe for a little bit of a pullback. But it doesn't mean to say that the bull market is over, not from a long, long way. I think the general trend is still going to be upwards, and there's armies of investment managers out there who don't have enough gold in the portfolio. About a week and a half ago, 2 weeks ago, I attended an investment conference at which many chief investment officers were speaking, from family offices and from some major banks. And I recollect in particular one of the major banks, it happens to be the one I bank with, was speaking, and he was saying, of course, with gold going higher, we've got it in our portfolio, we're recommending it to our clients, and we're using it in our discretionary portfolios. I thought, that's interesting. because my portfolio, discretionary, has got a 0% performance this year. I wonder if there's any gold in it. So I went to have a good look. And there wasn't an ounce of gold in my discretionary portfolio, despite the fact that CIO is standing on the stage telling everybody that they're smart because they put gold into the portfolios. So here's the reality. I think across the board, investment managers would like to say that they're in gold, but a lot of them haven't yet done it, at least not for all their clients. It's one of those things which is work in progress, and they've got to get it done by the year end, because at the end of the year, people are going to be getting their portfolios. They're going to be looking at the portfolio and saying, did you own the asset which beat NVIDIA, which is gold? And they can't not have it. So I think that's the direction of travel from the investment world. The question is, how much are they going to put in the portfolio? Will it be 1%, 2%? I did read one or two banks are saying 5% is the right number. And there was one bank, I think it was Morgan Stanley, even came out and said, now we're 60, 20, 20, with 20 in gold. Now, whether they're really putting 20 in the gold or that's just a sort of general comment, I don't know. I mean, it's not possible to put 20% in gold for every investment manager on the planet. There's enough gold out there at any price, so that won't happen. But, you know, if every investment manager could get to, say, an average of 2%, and I understand the figures are on average below 1% at the moment, that would push the gold price a long, long way.
In recent months, I attended investment conferences where chief investment officers publicly praised their gold allocations. Yet privately, in their own discretionary portfolios, many held no gold at all. The reality is that despite vocal support, adoption has lagged behind rhetoric. Across the industry, average allocations, where permitted, remain below 1%. Some institutions suggest 1 to 5% is a correct allocation, while rarer forecasts propose much more. But structural portfolio mandates, such as equity-only or fixed-income funds, often cannot legally or practically hold gold, restricting uptake. The gap between belief and execution is now narrowing.
Perhaps the below 1% number, I think, is a correct number, but to put it in context, a lot of the investments out there could not be in gold because they'll be, for example, an S&P 500 fund. It cannot be in gold. It'll be a fund dedicated to small caps. Can't be in gold because gold isn't an equity. So there's a lot of funds which just can't be in gold at all. So when I say below 1%, it's an accurate figure from what I understand, but it does encompass all kinds of investment vehicles which couldn't own gold under any circumstance, not allowed to, because it's not part of their mandate. So probably the real figure, which is actually invested where it's allowed to be invested in gold, is probably more like 2.5%. So I'd say for those mandates which can invest in gold, if they can get to 5%, we've got a large rise in the price coming. First of all, I'd say they cannot afford not to do it. So it's going to happen, in my opinion. The real question which is out there is, well, three questions really. One is, will it happen? And I've answered that one. I think they cannot afford not to. The second question is, when will it happen? And the third question is, at what price? Now, there's been a lot of numbers bandied around about the right price, and I postulated that it might be $15,000, which I felt was the right level to, one, cover this year's deficit, a bit of next year's deficit, and pay off the maturing bonds in the next 12 months. So they could have a year or two of grace where the government debt actually goes backwards instead of forwards, because there'll be, as bonds mature, they'll be repaying them and not having to borrow. And as far as the current deficit is concerned, based on my $15,000 level, at least for a year and a bit, they would be able to pay all the bills without running, or all the excess bills above what they're collecting taxes, without running into deficit territory. So the debt of the government would be, for a year or so, maybe a year and a half, 2 years, be going backwards. And it would give a little bit of breathing space to work out what they'll do going forwards.
One of the more audacious ideas I floated recently is that gold could ascend to $15,000 per ounce. The logic: at that level, gold might help a government cover deficits, pay maturing debt, and even reverse debt growth temporarily. The U.S. federal debt is growing faster than the economy. Past data show that about 8% of tax revenue once covered interest. Now nearly 18% does. Some forecasts suggest that interest may soon consume over 20%. When that burden becomes unsustainable, gold emerges not merely as a safe haven, but a forced hedge against fiscal instability.
Because obviously the debt cannot continue increasing ad infinitum, because it can increase ad infinitum provided it doesn't increase faster than the economy. But unfortunately, it's increasing much faster than the economy. The economy is growing by 1 or 2 or 3%, and the debt is increasing by 6 or 7%. So that can't continue. It's like you have a credit card. You might get a higher salary, but if your debt on your credit card is increasing by 10% a year, but your salary is only going up by 5% a year, you're actually going backwards, and in the end you're effectively bankrupt, because you get to a point where the interest you're paying to the credit card company exceeds everything you earn. And that's the situation and the direction of travel that the government's in. And it's not just me saying it, it's the Bureau of Labour Statistics themselves who say the same thing. So 2 or 3 years ago, about 8% of government receipts went into paying the interest on the national debt. This year, it'll be 18%. So we go from 8 to 18% of the interest paying, of the tax collected going and paying debts. And the Bureau of Labour Statistics, if you read their official budget, which was brought out last January, so it's very, very old, and it's got worse since then. But when they brought out in January, they postulated that they predicted it. If you look at their own numbers and crunch them, you'll find that they're going to, in a couple of years, 22% of GDP. And that's based on an assumed interest rate that the government will be paying, which is significantly lower than the lowest rate they can get at the moment. Because the lowest rate the government can borrow at the moment is something like 4%. But the assumption is that interest rates are going to be knocking around 3% for all maturities. That's the Bureau of Labour. So they've underestimated the number. But even with that underestimated number, that debt is going to go to 22% in a couple of years of not the debt. The interest they're paying is going to go to 22% of what the government collects in taxes. Now, if you project that forward ad infinitum, you get to a point where the interest payments become a larger and larger share of the taxes being collected. And the question is, at what point do investors say, I'm on a hiding to nothing. I'm not going to be repaid in anything which is worth something, because this is just spiraling out of control. If it was your best friend, you unless you wouldn't lend him money, you might give him the money because you feel nice to him, but you wouldn't believe that if he had a credit card debt of that size, that you've got any chance of ever being repaid. Now, people say, I will be repaid, because the government can effectively print money ad infinitum. They can tax the population ad infinitum if they have to. They could charge people, everyone, 100% of what they earn, and hopefully get it back. So people still believe that they're going to get it back from the government. But the reality is, if you do get it back, you're going to get it back in heavily devalued dollars 10 or 20 or 30 years from now, and it will not buy you the kind of things in retirement that you could buy with the same amount of money today. Is going to buy you an awful lot less. So I think it depends on where you are in life. If you're living hand to mouth, these things don't really affect you, because it comes in one end and goes out the other end, and if prices go up, your salary will probably go up with it. But if you happen to be a wealth accumulator, you're now in a battle to say, what can I do to preserve my wealth? Because otherwise I will be going backwards, especially if I've got $1 million in government bonds or Apple bonds or anything else like that.
The climb in gold is not happening in isolation. Central banks continue to accumulate reserves, especially in emerging markets, shifting allocations away from fiat. In Q2 2025, total gold demand rose 3% year-on-year, while its value surged 45%, driven largely by investment and institutional flows. Simultaneously, exchange-traded funds backed by gold are witnessing record inflows, adding liquidity and legitimacy to speculative and strategic buying. Combined, these forces, official accumulation and ETF demand, form a structural undercurrent pushing prices upward.
Depends what you're measuring it against, but if you're measuring against foreign currencies, of course, they're all falling together. So the pound, yen, euro, Swiss, even the Swiss franc, they're all, along with the dollar, they're all going down together. So when you look at the dollar versus a foreign currency, it may seem to have lost only, let's say, against the euro, only 11% this year, which is just a normal annual movement. Sometimes it goes up or down 11%. But if you think that both the dollar and the euro have probably lost 20 or 30% against gold this year, so they both are going down, and the whole world's watching dollar-euro balance, but they're not watching euro gold or dollar gold and saying, well, hang on a minute, in real money, if I own dollars, I don't have as much real money, being the gold, as I would have had a year ago by a long shot. And it doesn't matter which currency you look at. And that's not just new today. This has been going on ever since the world went off the gold standard. So that was in 1971 as far as the USA was concerned. The rest of the world had effectively come off the gold standard before that and gone on to what was since 1944 a dollar standard. So the US dollar was on a gold standard at a fixed rate of $35 an ounce. So the whole world, not Americans, but the whole world except Americans, were allowed to change their dollars into gold at $35 an ounce, or vice versa. And the US Treasury stood ready to deliver gold to any foreign nation who said, can we have our money back, please? And that all went on just fine and hunky-dory until the government the US government had continued to borrow more and more and more money, with the whole world believing they could turn it back into gold. And then some nations started to realize, well,
gold recently breached $4,000 for the first time, fueled by pacts of uncertainty, U.S. fiscal gridlock, geopolitical turbulence, and expectations of interest rate cuts. Analysts now raise near-term targets. Goldman Sachs expects $4,900 by end 2026. HSBC sees moderate upside. Yet risks remain. A policy pivot, stronger dollar, or profit-taking wave could trigger corrections. Key technical supports, 3,700, 3,500, may buffer dips. But on balance, the intersecting pressures of debt, reserve diversification, and investor psychology suggest the upward trend still has legs.
They've borrowed more than they've got in the bank in gold, so they can't pay everybody. Let's try and be first. So country after country started asking for their gold back, which started to drain the USA of their gold reserves. So it got to a point where Nixon said for these speculators, these wicked speculators speculating against our currency, we've got to put a stop to it. So we'll temporarily close the gold window so that these wicked speculators, meaning foreign central banks who happen to hold a lot of dollars, couldn't change their dollars into gold anymore. And from that day on, the United States, it didn't happen immediately, but slowly, after a few years, they started to realize, well, it doesn't matter if we borrow more and more. It doesn't matter if we spend more and more, because nobody's going to come asking for their gold back, because they can't. They're not allowed to. So the gold price was floating freely. And of course, the more that the government got into debt, and it got into more and more debt year after year. Back then, the debt of the US government was in the billions. I don't know what it was. Now it's in the trillions, 1,000 times as much. But the more and more they got into debt, the more and more money was in the hands of other people. And as more and more money got in the hands of other people, some of them said, I'll put some of that in gold, thank you very much. Of course, it benefited house prices, it benefited the stock market, and it benefited wages and salaries and everything else on the planet. Kept in a way, I'm not saying it's wrong, but it certainly kept the economy in a almost perpetual boom. I mean, since I started work in 1975, I guess I've only seen 4, 5, 6 large stock market declines, or crashes, if you like. Maybe some of them were crashes, some of them were declines, in 50 years. That doesn't seem a lot to me. But every time there's a crash, well, you never, broadly speaking, you never had time to buy. So the best thing to do in a crash was do nothing, and the market would go down, then a year later it would be back up, and it'd be another all-time high. I mean, I've seen hundreds, possibly thousands of all-time highs. I've never yet seen an all-time low.